Hello. In this video, we'll be discussing the inventory cost flow, specifically the weighted average method, and we will be going over the periodic versus how to do it using the periodic inventory systems versus a perpetual inventory system. Let's discuss the cost flow of inventory real quick as a refresher. And this is the point of these next few videos. When we take our beginning inventory plus our net purchases, we get this subtotal cost called goods available for sale, cost of goods available for sale. And then we're going to subtract our ending inventory, and that's how we get our cost of goods sold number. And there's various ways to calculate that, and one of those ways is using the weighted average method. We're going to use this example in the next few videos for the weighted average, the LIFO and the FIFO, which are in different videos. But you'll be getting really familiar with this one example. And we use a Converse company has the following inventory information for the year. And what it does is it tells us on each date, well, on January 1, it tells us we have our beginning inventory of 4,000 units at $5.50. So that gives us $22,000. And then it made these various purchases on these dates. And they made different, these units, and each of those batches were different units. So the January 17th, we purchased 1,000 units at $6. March 22nd, 3,000 units at $7, etc. And so when we take our beginning inventory, plus these are our net purchases, this 71,500 is the cost of goods available for sale. That's what that is. And what we're going to figure out is how much of that 71,500 will be allocated into ending inventory versus the cost of goods sold amount. In this video, using the weighted average method. And then the example also tells us that on various days throughout the year, they also sold a number of units. Notice they do not tell us how much those units are sold for, because for purposes of calculating the ending inventory and cost of goods sold, it doesn't matter. So what the problem tells us is that we beginning inventory is 4,000 units. We acquired another 7,000, so we had 11,000 units available for sale. And then it tells us that at the end of the period or the end of the year, we still had 4,500 units remaining in inventory, which means that we sold 6,500 units during the year. Okay, so when you take your ending number of units plus the number of units that we actually sold, so here's the ending number of units plus the number of units we sold, we have 11,000 units, which is what our units available for sale was throughout the year. So this is just the facts again. Okay, so again, we're going to take the 71,000 and try to allocate it between the ending inventory and the cost of goods sold. That's what we're going to try to do right here. There are three different ways you can allocate those costs between ending inventory and cost of goods sold based on some assumptions. In a previous video, we did specific identification. In specific identification, there are no assumptions because each unit sold is specifically identified to a specific batch, and we know exactly what the company paid for it, and that's what is allocated to the cost of goods sold. But that is very costly and only used by very few companies. So most companies, other companies, use one of these three other methods, and each of these methods they assume which units of inventory have been sold, and which remain in inventory. And think about companies that have very large quantities of inventory coming in and out the door. So if you're thinking about Costco and they have lots of different products, they purchase different products and they sell different products, they have to make some sort of assumptions in order to be able to allocate their costs between cost of goods sold and ending inventory. So the three cost flow assumptions are average cost, or also known as the weighted average cost. And that assumes that your inventory cost is a mix of all your goods available for sale. And we'll go through that. You have first in, first out, or also known as FIFO, which means that the units that we first purchased are the first ones sold. So think about like a Pez candy. I don't know if you know what Pez candy looks like, but in Pez candy, you put the candy in, and the first candy that you put in is the first one that comes out. So that's the cost flow assumption for FIFO. And meaning the your ending inventory, what stays in inventory, is your most recently acquired units. And then LIFO is the opposite of FIFO. It's last in, first out. And this one assumes that the units that you most recently purchased, or the units that last acquired, are the first ones to be sold. And the way I like to think about that is a laundry basket. You put your laundry inside your laundry basket. The first units, the first pieces of clothing that are going to be put into the washing machines are the last ones that you put on top, right? The most recent ones. So here's just a diagram of the different kinds of inventory cost flows. And let's look at the first in, first out. So this one just kind of assumes that you purchased 3 different batches of merchandise, of supplies. Let's say you sell boxes of paper clips. And so you bought a box on May 1st for $45, on May 3rd for $65, and May 6th on 70th for $70, and you sold one box at $100. So FIFO says first in, first out. The first one you purchased is what we're going to assign to your cost of goods sold. So the first box that we purchased, the oldest box, is May 1st. So we assign $45 to cost of goods sold, and our gross profit is 55. And the remaining amount that we have in inventory are these two. These two boxes are what remain, the $70 plus the 65. The LIFO, last in, first out, assumes the opposite. We sold $100, right? We sold one box, but the amount that we allocate to this cost of goods sold amount is going to be the very last one, the last purchase that we made, the most recent one is the first one out. So this is the last in. So this was the last purchase that we brought into our warehouse, is the first one we sell. So we say, okay, that's what gets allocated to cost of goods sold. And our ending inventory right here remains, this is our ending inventory of $110. And the weighted average takes the average cost of these three, and that ends up being $60. We'll go through that mathematics, and it just says the average inventory remaining is 120. So we'll go through all that. But this is just kind of an overview of all the different cost flow methods. Okay, these are our facts of what happened during the year. Let's start with a periodic average cost. So if your company uses the periodic inventory system, it means that they only calculate the ending inventory amount and cost of goods sold at the end of the period, which in this situation, we will assume is the end of the year. So what it does, under the periodic, is it's only done at the end of the year. So we're going to look at our beginning inventory plus all of our purchase during the year, right? So here we have our cost of goods available for sale of $71,500, right? So this is our beginning inventory plus the 3 different purchases we made throughout the year. And so now the dollar value assigned to that is $71,500, and we have 11,000 units. on hand, okay? So when you look at the way a weighted average cost per unit is calculated, is it looks at your cost of goods available for sale divided by your number of units available for sale. And it says, okay, your average number, the dollar assigned to each unit uses this average of $6.50. And so what it does is it says, okay, we were told in the problem that we sold 6,500 units and have 4,500 units remaining in our ending inventory. And we assign each of those units the $6.50 cost. So our ending inventory is 4,500 units at $6.50. So it's $29,250. And that means our the number of units that we sold is 6,500. We assume it's sold an average cost of $6.50. No, it's the average cost allocated to those units sold is $6.50, and that gives us $42,250. So that's just your periodic cost. You do it one time at the end of the year, boom, you're done. The perpetual average cost under a perpetual inventory system, you continuously, is that spelled right? I don't know. Update your inventory for every single time you have an acquisition versus every time you have a sale. And so now you have what's called a moving average unit cost for each time inventory is purchased. And the way you calculate that is the same manner as in periodic to find out what that average unit cost is. And you take your cost of goods available for sale at that time divided by number of units available for sale at that time. So here's our set of facts again. Here's our beginning inventory, our purchases throughout the year, and our sales that we made throughout the year, the number of units. Okay, let's start. So our beginning inventory, we're told, was 4,000 units at $550, which is $22,000. So that's going to be our $22,000, our beginning inventory. And then on January 10th, we're told that we sold 2,000 units. Okay, that comes from right up here. So here's our beginning inventory of 4,000 units at 22,000. And here's our first sale on January 10th. We sold 2,000 units. So what's the price we allocate to those 2,000 units? Well, we don't have a weighted average because we just started. So we sold everything that was in our inventory was acquired at $550. So we allocate the $550. Our cost of goods sold is $11,000 for that sale. And that leaves us with an inventory balance of 2,000 because we started 4,000 and then we sold 2,000. So we have 2,000 units available in our ending inventory at $550, which leaves our ending inventory at $11,000 as of January 10th. Okay. So our next date on our sample sheet on our example is January 17th. On January 17th, we acquired 1,000 units at $6 for $6,000. So let's put that on here. Okay, so we already did through January 10th. Now we're including our January 17th purchase. So here's our purchases versus our cost of goods sold versus our ending inventory. So we have a column for each. On January 17th, we purchased 1,000 units at $6 for $6,000. So now every time you make a purchase, you have to calculate the average cost per unit. And the way you're going to do that is you're going to take your cost of goods available for sale, the total cost of goods available for sale, the dollar amount, divided by your number of units available for sale. So our cost of goods available for sale is we had 2,000 units at $550, right? That's what we had in our ending inventory. And then we purchased another 1,000 units at $6, which gave us $6,000. So our cost of goods available for sale is we're going to take this 11,000 plus the 6,000, so it gives us $17,000, and our number of units available for sale. How many units do we have? We had 2,000 units in our ending inventory as of January 10th, and then we acquired another 1,000. So we have 3,000, and that gives us an average cost per unit is of $5.67 per unit, right? And that's this number right here. And so what we're going to do is when you look at, let's just change this to like green. When you look at your ending inventory, because we know our ending inventory is this 3,000. When we look at the cost that the amount we're gonna allocate to ending inventory, we use our new average cost per unit of $5.66. So you take the 3,000 times that number, and your ending inventory as of January 17th is $17,000. Okay, so after that is March 22nd, and we acquired, let's change this back to red. We acquired 3,000 units at $7. So let's put that into our calculation. On March 22nd, 3,000 units at $7 is 21,000. And now every time you make a purchase, again, you have a new average, you have to calculate a new average cost per unit, right? And that's your cost of goods available for sale. I keep writing this down so it hopefully gets in your head more, times the number of units available for sale. And that is going to be, what's our cost of goods? So we had 3,000 units at January 17th that we valued at $17,000. And then we acquired another 3 more on March 22nd at a cost of 21,000. So you take the 17 plus 21, and that is, I can't do math that fast, it's 38,000. So we have the 38,000 divided by how many units do we have? Well, here on January 17th, we had 3,000, and then on March 22nd, we acquired another 3,000. So that's how we get our $633 per unit, $6.33. So your ending inventory has this $6,000, 6,000 units, and you allocate this new average cost per unit of $6,333, and it gives you an ending inventory number of $38,000. Moving on, now on April 15th, we made a sale of 1,500 units. So as of March 22nd, on our previous slide, our average cost per unit was $6.333, okay, $6.33. Now we sold on April 15th, 1,500 units, and so we just allocate our latest average cost per unit to that sale, and that's what we use of our cost of goods sold. So now we had 6,000 units, and we sold 1,500, right? That's what we sold. And so we have 4,500 units left in our ending inventory, and we use a $6.333 cost dollar amount to value the ending inventory at April 15th for $28,500. Two more transactions. October 15th, we made another purchase of 3,000 units at $750. So every time we make a purchase, we're going to recalculate our weighted average cost per unit. So let's go in here. On October 15th, here's our acquisition of 3,000 units at $750. So the previous ending balance that we had was 4,500 units at $633, which gave us $28,500, and then we acquired another $22,500. So the way we're going to calculate our cost per unit is we're going to take our 25 from right here, plus our 22.5 from our purchases from October 15th, divided by the number of units available for sale, which is we had 4,500 units available, and we purchased another 3,000. So that gives us 7,500, and that math is going to be $6.80. So when we allocate a value to the ending inventory, we have 7,500 units remaining in our ending inventory. We're going to use $6.80 as the price for those, and so our ending inventory is 51,000 at the end of October 15th. And then the last item in our example is we had a sale on November 20th for 3,000 units. And we're just going to use the previous slide was just right through here. And when we now we have to count for the sale on November 20th, we sold 3,000 units, and we are going to use the latest average cost per unit that we had, which is $6.80. So our cost of goods sold for those 3,000 units that we sold is $20,400, which means we have 4,500 units remaining in our ending inventory because we had 7,500 and then we sold 3,000, so it leaves us with 4,500 units, and we use the $6.80 to value that. So our ending inventory is 30,600. So for our cost of goods sold, our cost of goods sold throughout the year is you take your 11,000 from here, plus your 9,500 from here, plus your 20,400, and the sum of one is 40,900. That's going to be our cost of goods sold. The 40,900 is the sum of everything in this column right here. Our ending inventory is just our balance sheet amount, so we know it's just a period, a point in time. So this is going to be our ending inventory at November 20th, and we assume no other inventory was purchased or sold throughout the year. So let's just quickly see back to our beginning where we had our cost of goods available for sale was 71,000, and how are we going to allocate that between our ending inventory and our cost of goods sold? That was the question at the beginning of the video. So we have 4,500 units remaining in our inventory, and that is at, so here's our 4,500 at 30,600. So that's how I get this number. So now I have my beginning inventory plus my purchases, right, is my cost of goods available for sale, 71,000, minus my 30,600, minus, right, less my ending inventory, gives me my cost of goods sold of 40,900. That's how that math works. Now, hopefully, what I will see on my spreadsheet is that my cost of goods sold totaled 40,900. Let's check that. And here it is, my 40,900. So that's a good way to check. If you use your spreadsheet and you plug in your numbers for ending inventory and cost of sales, and it doesn't work, right? The math doesn't work, then there's something wrong. It's either something wrong in your ending inventory calculation or something wrong with your cost of goods sold calculation. But either way, it's a good check. So I just want to show you now real quick. This was using the perpetual inventory system, the weighted average method. Our ending inventory was 30,600. Under the periodic, which we did previously, the ending inventory was, wait for it, 29,250 versus 30,600. So, and then therefore your cost of goods sold is different. But I just want to kind of highlight the difference that it does give you a different calculation based on are you using the periodic inventory system or the average inventory system.